back with Martin Pelletier, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Martin, thanks very much for coming back for a second block. You reckon this is one of the toughest markets in years. You mean partly because of the unpredictability of the White House?
Yeah, I mean, it's more than that, too. You have a complex, very, very complex macro backdrop. You have global geopolitical tensions, the trade uncertainty coming out of the U.S., fiscal uncertainty. Was on your show a couple of days ago talking about global sovereign debt issues. And then you got diverging signals across different asset classes. You have the bond market, gold and Bitcoin, that are flashing warning signs of economic stress potentially. And equities are continuing to rally. I watched the interview yesterday with Morgan Stanley saying there's been 15 billion of daily inflows into equities, and every dip is being bought. And that's it's encouraging, but also a little concerning because it's suggesting more of a momentum-driven equity market, not one that's driven by fundamentals. And so that makes it very difficult from an asset allocation standpoint, being a portfolio manager.
That's interesting. The machines, the algorithms, they see a trend and they jump on it regardless of the merits?
Absolutely. And so that's causing some investors to maybe have some fear of missing out. And maybe, I'm not doing so well in my bond portfolio. Maybe I should sell my bonds and buy, like you had mentioned, NVIDIA's up 40% from its lows. Why don't I have NVIDIA in my portfolio? Maybe I need to own some of it now. And so there's a lot of that going on. And that's just something you want to be cognizant of. We're staying selective, defensive, and opportunistic, and keeping our eyes on the scoreboard because there's just it's time to exhibit some discipline and not bravado, in our opinion.
You reckon that when you look at the bond market, gold and Bitcoin, we're seeing caution lights going off, red lights, warning lights. What do you mean? Okay, so
bond yields are at highs and going higher. And that's typically when bond markets and our yields are moving higher, it's saying that there's trouble out there, both in corporate and in government sectors. Gold typically rallies during times of upheaval, and there's concerns about the ability for monetary stimulus and continuing monetary policy with low rates and quantitative easing may not be able to be done any longer because of inflation and tariffs. And then Bitcoin, that's a big question mark, but it's doing well. Typically, some people view it as a hedge against that fiscal uncertainty and the monetary uncertainty. So you've got those three areas that are saying things aren't well, and yet equity markets are plowing ahead. Mm-hmm. So there's a dichotomy there, and someone's going to be right and someone's going to be wrong.
You're a keen watcher of the energy market. Maybe we can put up a 5-year chart for the TSX Energy Index, or maybe actually even XEG, the energy producer ETF. You reckon rallies in energy should be sold right now? Yeah,
they're just reading the pulse of what's happening out of OPEC and President Trump. Trump wants lower oil prices. He's said as much over the last couple of weeks, especially with his visit to Saudi Arabia. He wants lower oil prices, even if that means throwing U.S. shale under the bus and giving them a good old-fashioned rug pull. And OPEC is more than happy to comply. And that means the U.S. shale production is going to accelerate to the declines. And that means that market share is going to be relinquished to OPEC. So this reminds us a little bit of 2014. And so we're not going to see any sort of spikes in oil prices, albeit there could be an Israeli invasion of Iran, although the U.S. is doing its darn best to make sure that doesn't happen in regards to leaking information about that potential action. Mm-hmm. And so as a result, you're going to see the oil sector under pressure, not a lot of upside under oil prices, and demand maybe faces a flatlining demand. So near term, it doesn't look quite as exciting. Longer term, eventually the global supply market will be out of balance. There'll be a shortage of supply and an increase in demand, and longer term there'll be some good opportunities. but near term, we expect some weakness.
Right, that's interesting. An Israeli attack on Iran, you mean? I guess they wouldn't be sending they wouldn't be sending the Merkava tanks in there. Well, you never know with Israel. They don't mess around. What about the telecom stocks, including our own parent company, BCE? What's your attitude there? Do you see value?
They've been really beaten down, and so looking at that sector compared to the banks have done really well. Maybe it's worth taking some profit and rotating into the telecoms. We don't own BCE directly, we own it through structured notes, but we like it now with the dividend cut. It shouldn't be announcing expansions into data centers or anything like that. They just need to get their balance sheet fixed, and maybe a management change would be nice and welcomed. We like TELUS. That's our go-to name in the space. It's got a younger, faster-growing subscriber base. It's much more disciplined with capital allocation, and it's pretty well diversified. So you've got some nice yields there, multi-year low valuations. It could be a defensive rotation if growth slows or rates stay volatile.
Thank you very much, Martin. Really appreciate it.
Bitcha, thanks for having me.
Martin Pelletier, Senior Portfolio Manager at Trivest Wealth at Wellington-Altus Private Counsel. Up next,